What's unfolding in today's credit markets almost never happens except right before recessions or full-blown financial crises. After Friday night's 19 billion crypto crash and more than 1.6 million accounts wiped out, Wall Street is somehow celebrating. President Trump says everything with China is fine. But what if this is really a fake out? Because deep in the junk bond market, a silent collapse is already forming. And it's forecasting a very painful 2026 recession. In this video, we're going to unpack what's actually happening beneath the surface. There's rising credit spreads, falling high yield prices, and spiking delinquencies. You'll see why bond traders are quietly rotating into dollars and what it means for your portfolio. Stick with me to the end because I'll show you 3 steps to protect your wealth from credit-driven market crashes. Let's get into it. Let's start with the junk bond breakdown. Now, this article from Bloomberg talks about the US bond rally came to a halt on Friday with the biggest one-day loss in 6 months. As risk premiums surged to near a 4-month peak, yields climbed to 6.99%, the highest in more than 2 months. Now, when the junk bond prices plunge back to the summer lows, that matters because the junk bond market funds America's corporate debt engine. When the spreads blow out and yields spike, credit dries up and companies start defaulting. This signals is unmistakable. Every similar widening in the last 2 decades, 2008, 2015, and 2020, preceded major corrections. The difference now is default risk is rising faster than the Fed expected. While economic data is thinning due to the government shutdown, the bond market doesn't lie. It's saying, and loudly, that the credit crunch is already in motion. Now let's get into the dollar and the global tension. The US dollar has rallied to a 2-month high. Usually that sounds like strength, but in reality, a surging dollar tightens financing across emerging markets and US corporations alike. Now, at the same time, China is really stepping up its game when it comes to rare earths. In this article from Bloomberg, we talk about the spat fuels and supply fears. So, rare earth stocks extended recent gains as fresh tensions between Beijing and Washington over China's export of critical minerals fueled by bets on alternative suppliers. At the same time, these new restrictions are just going to cause delays, and they're citing national security, as we mentioned in previous videos. On a separate note, an Australian newspaper reported potential plans for a broad rare earths deal between Australia and US. And the US needs to find alternative supplies because without it, China holds the higher edge in these discussions. And as you can see, the Australian rare earths miners had a lot of gains. One of them surged as the main one, is 27%. The other ones raised 8.5, 6.3, and their Australian strategic mineral raised 42%. So this is on the news that there might be a deal forming. So anyways, without enough supply, companies can't deliver products. So the revenue drops, the loans go unpaid, and that's how a trade war quietly becomes a debt contagion. Let's start with the charts before we look at foreclosures. In this chart, we see delinquency rates on credit card loans with correlation to average weekly hours of production. Now, you can see the correlation where hours go up, delinquencies go down. We saw that in multiple spots highlighted here on this chart. Right now, we are seeing foreclosures are up 17% year over year. And it might not look like it on this chart, but when you actually get down to the nitty gritty of the change rate, it is 17% up this year. But the more concerning number is that subprime auto loans, 60 days overdue, just hit 6%. And that's the highest on record. These aren't isolated statistics. There are a chain reaction. Consumers fall behind, defaults rise, bank tightens credits, and unemployment rises. And the charts prove it. Each decline in average weekly hours worked has historically aligned with surging delinquency rates. And once again, the dominoes are lining up exactly like they did before every major downturn. So what's the bond market predicting? It's pretty simple. Credit risk is rising faster than growth. Professionals are quietly exiting their high-yield positions and accumulating US dollars and short-term treasuries. They see what's coming: a slowdown in spending, weaker corporate earnings, and an inevitable Fed reaction by mid-2026. This isn't speculation. It's what credit spreads and currency strengths have always foreshadowed before a recession. Here's how you can prepare. Number one, review your portfolio for high yield or leveraged debt exposure. Increase your dollar liquidity or add short-term treasuries. And keep positioning flexible to rotate back once stability returns. And remember, the credit market moves before the headlines. That's why we're talking about it now before you hear it on CNN tomorrow. If you found this analysis helpful, hit like and subscribe and turn on notifications so you never miss our next breakdown. Stay sharp, stay informed, stay diversified, and I'll catch you in the next video.